All right, thanks for watching this. My name is Jim, safemoneysinger.com. You know, it's often been said about relationships that it's easy to get into a relationship, but sometimes it's really hard to get out of a relationship. I don't know if that's a good analogy or not, but I want you to understand that when it comes to annuities, the decision process is kind of like that insofar as people often think, well, if I get that, I can't get out of it. And it's really not that way. Annuities are not irrevocable. There's at least 10 ways in this video I'm going to share with you how you can exit your annuity if the circumstances warrant it. And if you understand these circumstances that you can get out of your annuity, you might feel more comfortable about getting into it and taking advantage of the benefits that only annuities can provide. So obviously when it comes to insurance contracts that you choose in retirement with your retirement funds, you're interested in either lifetime income generally or income for a period of time in a term certain format, or you want to preserve your principal on a guaranteed basis. These are contracts that the insurance industry will write and give to you for the protection of your funds. But the problem for a lot of people is I don't want to tie up my money. So let's discover the nuances here and see if we can square this circle. So there's about 10 ways that you can get out of your annuity contract. So if you're choosing annuity for lifetime income that the stock market can't compete against and banks certainly can't, or whether you're choosing an annuity just to have your principal stay safe and your earnings to be locked in every year, it's really helpful to understand why you would get an annuity in the first place, since you might think that you can earn the income benefits or the principal preservation characteristics with bank funds and or stock market funds. So there's two ways that insurance companies essentially are able to offer promises that are better than the mutual fund industry, for example, or the banks in terms of income guarantees. It's called risk pooling because insurance companies by their very nature are not investment companies. They're actually insurance organizations that are designed to protect you from something that you're concerned about. So if you're concerned about running out of money, insurance companies will do that because they're the only institutions that actually take human life expectancy tables and determine how long a general population is going to live, and they're able to offer income promises that are higher than the banks and the securities industry because they know in advance how many individuals in any given year of a group of people that are purchasing the same insurance product are not going to be around anymore. It's kind of morbid, but that's what insurance companies do. They determine life expectancies, and because they know that in advance, they can make promises above and beyond what is even reasonable from the naked eye, so to speak. So this is a fact of life with insurance companies, and they do this because the people that buy insurance, in this case the insurance, the risk of running out of money is the insurance that's being purchased. The insurance companies have an agreement with you, and you agree to this when you buy an annuity, to limit your access to your funds. So the insurance company has limited liquidity in annuity products for the term of the contract, whether it's 5 years or up to 10 years, for example. And they enforce this essential illiquidity provision by what are called surrender charges, which is a penalty schedule, and you agree to that in advance when you buy your annuity. It's a sacrifice that you make in order to get the higher income guarantee or the principal preservation guarantee that you're looking for in retirement. So as you're making your decisions about getting an annuity, what about if you just want to change your mind at some point in the future for any reason whatsoever? Is there a way to avoid these penalties so that you can feel better about getting into an annuity in the first place? Let's cover the liquidity privileges that are available from fixed rate annuities and from indexed annuities. Typically, it's interest every year, and or 10% of the available balance in any given year can be taken out during the term. The term of most of these annuity contracts, whether it's fixed rate annuities or indexed annuities, is generally 10 years. Some states allow for 15-year contracts. I actually don't sell those very often. And then beyond the 10% liquidity privilege in these contracts, you have what's called a surrender schedule. And the surrender schedule will decline every single year, and it's only applied, unlike a bank which often charges the penalty on the remaining principal in the account, the annuity industry only charges the penalty on any dollar that's taken out over the 10%. So example, in the first year, if you took out your 10% privilege, but you wanted $1 more, than that 10% privilege, the insurance company would charge you 10 cents, and that would come out of your current balance in the account. So let's use an example of 100 grand growing at 5% a year. And let's say, for example, that you want to take a $30,000 withdrawal in year 5. You can see there's a 6% penalty there. So here's the formula. You take your free 10% of the available balance, which is 121 grand. That'll give you 12,155. Now you wanted 30 grand, so the other remainder of that would be 17,845, and that's the amount that would be penalized on the surrender charge. So you take 6% of that, and $1,070 would come off the available remaining balance in your annuity contract. That's the price that you would have to pay to have an annuity contract that gives you the peace of mind of principal preservation, annual earnings preservation, and income guarantee preservation. You would have to pay this particular fee if you wanted to take out a withdrawal more than your 10%, in this case 30 grand, it would cost you $1,070. Now you have to weigh that penalty against the risk-based alternative in the market, right? Or the liquidity restrictions of a bank CD, for example. This is the decision matrix that you have to make when you're getting into annuity contracts, knowing that you're going to sacrifice some liquidity, and there will be a charge if you decide to transgress the 10%. But we're going to cover some of the ways that you can get around these surrender charges. So here would be your available balance in this scenario if you took $30,000 out. So let's cover the 10 options to get around surrender charges. So the first way is, if you have an annuity contract already, you can always call the insurance company and ask them to do a quote for you for a full annuitization. And what that is basically they'll take your current account balance and they'll pay it out to you over any term that you want, generally 5 years, 10 years, 15, 20 years, or a lifetime. And there are little idiosyncrasies to how you can take those funds with or without a death benefit, with a joint payee, et cetera, et cetera. Now, the full value annuitization is a product-specific request. So you have to ask your insurance company, can I get my full value today paid out over 5 years, for example? They may say yes or no. It will depend on that particular contract. Typically, insurance companies often might make you wait 5 years, but there's lots of contracts out there that will allow you to annuitize it for the full value after the first year even. So if you haven't bought your annuity yet, ask your agent if you can always annuitize the full value of the current value for as short as 5 years. You can't go less than 5 years, but you'll get all your money back with an internal rate of interest applied to it. So that's a feel-good proposition that you could take advantage of as well. That's the first way to get your full value. Let's try the second way. Now, this is less attractive, of course, because we can't induce a sickness, but if you are confined to a hospital or a medical facility or a long-term care facility, almost all the contracts have waivers in this regard. Some of them are 30-day requirement of confinement. Some of them are 90 days. Some of them will give you 50% of the money up front. Most of them will give you 100% of the money. The MIGA industry, the fixed rate industry, because that particular guarantee is pretty severe for the insurance industry, has less liberal policies as regard to this go. So you're not going to get too many medical waivers with fixed rate annuities, but with indexed annuities, you can get really good medical waivers to get out of your contract if you have a medical need that goes for 30 to 90 days. That's the second way. So here's the third way. This is called a ROP, or return of premium contract. This is where the insurance company tells you up front, this particular contract allows you to cancel the contract after 1 year, 36 months, 48 months, whatever it is for that contract, and you can take 100% of what you originally put into the policy and get it back. Now, keep in mind that does not include any fees that might have been in the contract if they did exist. It also does not include any interest earnings that you might have earned, and it also doesn't include any withdrawals that you've taken. So it's a little nuanced that way, but if you want to get 100% of your money back that you put in, minus any withdrawals, minus any fees, then you can get your principal back in that regard. That's called a return of premium feature. There's also some contracts, a half a dozen to my current thinking, that offer free liquidity with no fees up to 15% annually. That's pretty good. Keep in mind, you don't necessarily, if you're having a financial circumstance, most of the time people don't need to cancel 100% of their annuities. If you have a more liberal liquidity provision, it might work just fine. And there are also contracts that allow 20% liquidity, although they generally come with a 40 or 50 basis point fee attached to them to get that privilege. Generally, the way these things work is if you don't take out your 10% in 1 year, the insurance company will automatically double it for the next year. So these can be taken advantage of as well. That's number 5. Number 6 is get what's called a bailout feature. So a lot of index annuities have all these different measurements by which they apply growth to your contract. And for example, if they measure the S&P over a 12-month period from beginning to end, you could get a cap rate of, say, 7%, which means the insurance company will give you as much as 7% as an example. And if the market does 10, you get 7. If the market does 3, you get the 3 because it's under the cap. If the market loses 20%, you get a 0. You never lose anything with any type of annuity contract like this. But they'll have a cap, a bailout rate of 4%. They'll say if the market is such that we cannot afford to give you at least 4% cap on your S&P, then you reserve the right to cancel your annuity contract for the full accumulated value at the time of your cancellation choice. So that's an option too. Those have bailout features for all different types of crediting strategies there. The other obvious option is to just not put all your eggs in one basket. If you're concerned about access to most of your principal, then just put into the annuity what you need to accomplish the guarantee of protection that you're looking for. So if you're trying to preserve a certain amount of principal for the heirs, for the kids, or for the spouse, or just for the future for a rainy day, then just put that amount into the annuity. Or if you've done the due diligence to run budget calculators on your own, or on my website, safemoneysinger.com, just put as much as you need in there to cover your income guarantees for the future, and then whatever you have left, keep that more liquid for your own peace of mind. Number 7. Number 8, transfer funds to a new annuity. Now this obviously will not be necessarily attractive to people that want to get their cash out to go buy a car or a house or just put their money in the bank. But if for whatever reason you're unhappy with your current annuity and you want to transfer it to a new annuity, but you don't want to take the surrender charge, well, there's so many annuities in the year 2026 with outstanding bonuses, and from a compliance and regulatory point of view, that's completely allowable to transfer an annuity with a surrender charge to an annuity that's going to give you a 10 or a 20 or 30% first year bonus, because the bonus will obviously completely compress and diminish the cost of getting out. You'll actually come out ahead in year 1 with a bonus annuity. So that's an option you can consider as well. Number 9, also forgot here, if you get to the point where the money is designed to go to heirs, for example, it might behoove you to take the hit on your annuity and transfer it to a life insurance policy if you're healthy enough or if you're young enough, because life insurance pays really large guaranteed tax-free death benefits, and it might be significantly more than what the annuity is, that even with a penalty canceled annuity, you can double or triple your money for insurance guarantees. That's assuming you want to leave the money for heirs. Okay, number 9, finish your contract. If you're close to finishing your contract, then there's no reason to take the penalty to cancel it early unless there's reasons that you just can't avoid. But try to remain to the end of your contract if you can. And once again, you can always annuitize your contract as well. And then the last thing is to simply not get an annuity. I call this white knuckling your retirement needs. You don't have to buy an annuity. An annuity is not right or wrong. An annuity is an insurance product. People buy insurance product based on their risk aversion or their risk tolerance. I am a rather unique, perhaps, annuity agent out there that doesn't say you need to buy an annuity. I simply present the aspects of an annuity. And if you are fearful, which a lot of annuity shoppers and buyers are, that you cannot earn the type of yield you need to guarantee your income, for example, in retirement, or you can't preserve your principal on a guaranteed peace of mind basis in the market, or you can't get the liquidity, the highest payout you can from your bank, then I would recommend you get an annuity. But if you think you can get the benefits from annuities on your own with your current financial planning arrangement, then all power to you. But if you are in the business of shopping for annuities, or if you own an annuity, but you just need to reevaluate or recalibrate your need for one, then I would recommend 2 processes here. Understand the cost of liquidity. So in other words, if you buy a bank CD, what kind of income can you get from that versus what the income provides from an annuity contract? And then also reevaluate the market. If you are a market-oriented person, can I get the same benefits from the annuity in the market reevaluate that, because you can get the answer to both of these questions on a factual basis, and then you can decide if an annuity is actually for you or not. So let's get into that real briefly. Now let's imagine here a couple age 62 and 58 with this amount of money, and the youngest borrower is 58. I shouldn't say borrower, but youngest purchaser is 58. The income comes out to this a month, and there's the salary right there. Here's the internal rate of return over a lifespan. Here's the cash flow rate, and here's the money that comes back. So let's imagine that you decide not to buy the annuity. You want to stay in the market instead, and you want to get the same benefit that the annuity is providing, but you want to get it from the market. So there's the salary that you're allegedly getting from the insurance company. Can you get this from the market? Well, it depends on essentially how long you're going to live. So the internal rate of return can be reverse engineered here. So here's your income being deducted annually from your $800,000, earning 5.58%. And we know that the 5.58% is accurate because by age 93 here, the money has fully ran out. So this is what you would need to get in the market on a guaranteed basis. It might not sound like a lot of money, 5.58%, when the market is white hot, obviously. But once again, annuities are purchased by people that just don't want risk. They want certitude. They want certainty that they can get to where they need to get to without any variabilities. And so the market, which is white hot at this time, but it could change tomorrow, you have to annualize 5.58 in the market. And by age 93, you would be out of money in the market if you earned 5.58. If you earned over this, well, obviously, then you'd have a cushion by age 93. And if you earn less than this, you'd run out before. So this is the reason why people choose annuity contracts, is because they know the market is not guaranteed, unlike insurance contracts, which are guaranteed. Now let's imagine you want to get the same benefit from the banking industry. Let's imagine you got a 6% CD, which does not exist, but let's say you did, and let's say it wasn't a term, it was for life. Can you compete against the insurance industry with a 6% CD for life, even though it doesn't exist? Let's check it out. Here's your $800,000. And it's growing at 6%, and this looks really good actually, because even by the end of age 92, there's $354,000 left. That's ideal. You don't have to tie your money up in a annuity. You can tie it up in a bank CD if that makes you feel more comfortable. But the reality is this. Here is the balance left over. The reality is liquidity from bank products just don't cut it. So here you go. Take your $51,000. Divide it by 772 grand, that's a 6.73% payout. Even if you could get a 6% CD, you're only allowed to take your interest out, right? So you're already in a penalty phase when you're taking out your very first payment here in this example of starting in 5 years of taking out payments. You're taking out over 6% the first year, come to think about it. So there's penalties all through this illustration right here, and this is the fact of liquidity with banks, and banks have to have a line in the sand somewhere, so they only let you take your interest out. The reality is the income guarantees from indexed annuities with income riders, or even single premium immediate annuities, SPIA contracts, for example, the income benefits are so high that banks are not mathematically able to compete. And this is essentially a function of the insurance nature of annuities. Only insurance companies are able to offer these really high payments because they've got the books. They've got the books on us. They know how long we're going to live. And because they know how many people aren't going to be around in the future or at any given year, they can afford to offer higher promises because they know that they won't have to honor them to people that aren't here. It's kind of morbid, as I said earlier, but that's the way insurance works. It works that way with car insurance, house insurance, health insurance. It's all very similar to what's called the law of large numbers, which is the nature of insurance contracts. So here is your guarantee, in this case for this couple here, of getting a salary, assuming one of them lived to age 93, the annualized yield would be 5.58%. Peace of mind, nothing to pay attention to. It's all guaranteed from day one. And if this is a compelling argument, then you are an annuity shopper or an annuity buyer or an annuity owner. If this is not a compelling argument, then you're just not into annuities. There's nothing right or wrong about it. You don't have to buy an annuity. Annuities work for people that are not secure about their retirement. It doesn't make them less than honorable people, of course. Annuities have been around a long time. These were invented for these types of needs in the first place, to give you some type of peace of mind in retirement. So I think that's all I had in this particular video. Let's synopsize everything. You want an annuity because you don't want to have bank penalties to get a high salary, and you don't trust the stock market to protect your funds, but you're scared to get started, understandably so, because you know you're going to have to give up some liquidity. So how do you get around that? There's 10 ways to do it. You can always get your money out over a 5-year period at the shortest scale. Just make sure the contract allows that as soon as possible for whatever reason. Some contracts make you wait 5 years before you can do that. Not all of them. You can always use the medical waivers. Those are the most liberal ways to get your money out, of course, but we don't wish any sickness on anybody. The other way is to get a return of premium contract. Ask your agent if the return of premium feature is available in your particular contract. Ask the agent if you can get higher liquidity, 15 to 20%. Ask what bailout features are available. Always keep money in cash reserves for emergencies, obviously. You can always transfer to a new annuity if you're unhappy with your annuity at any point in time. And finish your contract. Avoid surrender charges altogether. Now, it's important to understand that because the insurance industry is regulated, you can't get all 10 of these things here, or all 9 of them, I should say. You can't get all 9 of these features in one annuity. It's just not possible because every insurance company has their limitations within the confines of the Department of Insurance in the state that they're operating in where they're selling contracts. It would be great if you could get most of them in some contracts, but we'll do our best to find the right contract for you. But just keep in mind, the insurance industry is highly regulated, and it's physically impossible for one insurance company to give everything, because then they would have to essentially deplete their reserves, and that would be transgressing the insurance laws, because insurance companies have to keep a lot of money in reserve to guarantee the promises they're making, and that's how it works. All right, well, thanks for watching this. My name is Jim, safemoneysinger.com. Let me know if I can help you. Thank you.
Thanks for coming to the home where you shop for a safe place to put all the money you got. And if a sleazy salesman has thrown you a zinger, you can always come back to the Safe Money Singer.